In the exciting world of currency trading, understanding sell signals is crucial for success. Sell signals indicate an opportunity to sell a currency pair, like the USDJPY, with the expectation that its value will decline. Recognizing these signals allows traders to capitalize on downward price movements and maximize their profits. By carefully analyzing market conditions, technical indicators, and economic data, traders can identify opportune moments to enter sell positions. Mastering the art of identifying sell signals is an essential skill for traders of all levels, from beginners to seasoned professionals. By recognizing the signs of a potential downward trend, traders can position themselves to profit from falling prices. It's important to note that no trading strategy can guarantee profits, and losses are a part of trading. However, by understanding and utilizing sell signals effectively, traders can increase their chances of success in the Forex market. When trading the USDJPY, identifying precise entry and take profit levels is paramount. For this trade setup, consider a sell entry around the 151.500 level. This level represents a potential area of resistance where selling pressure could increase. Setting appropriate take profit levels is equally critical. Consider a three-tiered take profit strategy for maximizing potential profits. Setting the first take profit level at 151.000 allows you to lock in some profits early. The second take profit level, 150.500, represents a stronger support level, a potential area for a more substantial price reversal. Finally, the third take profit level at 150.000 targets a key psychological level, which often acts as a magnet for price movements. While focusing on profit targets is tempting, protecting your capital is equally important. A stop-loss order is designed to limit potential losses if the trade moves against you. In this USDJPY sell setup, placing your initial stop-loss above the recent swing high, around 152.500, is recommended. This level acts as a logical point to exit the trade if the anticipated price decline doesn't materialize. Remember, trading involves inherent risks, and not every trade will be profitable. By setting a well-defined stop-loss, you effectively manage your risk and protect yourself from significant losses. In trading, effective risk management is as crucial as identifying profitable opportunities. It involves implementing strategies to protect your capital and maximize your winning trades. One such strategy is moving your stop-loss to break even once the price moves favorably in your direction. For instance, if the USDJPY falls to your first take profit level, 151.000, consider moving your stop-loss to your entry point, 151.500. This strategy ensures you won't lose any money on the trade if the market reverses. Another effective risk management technique is securing partial profits at predetermined take profit levels. This approach allows you to lock in profits gradually as the trade progresses, reducing your risk exposure. For example, you can close 25% of your position at the first take profit, 50% at the second take profit, and the remaining 25% at the third take profit. This way, you secure profits while still allowing the trade room to breathe and potentially reach your final target. Remember, successful trading is not just about being right. It's about managing your risk and protecting your capital. By implementing sound risk management strategies, you can navigate the Forex market with confidence and increase your chances of long-term success.